Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Hi, Will. How are you?
Doing pretty well. We're doing things a little bit differently today. We're talking this time on a Monday afternoon instead of a Tuesday morning. So a little bit of shift in the show.
Yeah, we've just ruined my whole week. My whole week's off. It's like when you miss church on Sunday and the rest of the week just doesn't feel right. No, I'm giving you a hard time.
Well,
Just
see, now you're going to think tomorrow is Wednesday, and then, it's just going to, all your meetings and classes, all that's going to get thrown to the wind.
that's right. Absolutely. All's good though. All's good.
So really diving into things kind of straight away, what adjustments have we seen in the markets from last week into this week?
Yeah. So starting with corn for December down 18 cents to 6.57. Soybeans in November were flat at 14.40. Soybean oil flat at 76 and a quarter cent per pound. Soybean meal was down $13 per short ton, down to $406 per short ton. Old crop wheat down 27 cents to 8.18. New crop wheat for July down 25 cents to 8.54. And then that West Texas Intermediate crude oil down $6.16 per barrel to trade just under 85 cents per barrel.
Maybe not too much action there necessarily, but what have been kind of the highlights coming into this week?
Sure, and we'll go through these pretty quick. Ethanol production was up for the sixth straight week this past week, up to 309 million gallons per week. USDA increased yields of U.S. corn and soybeans last week just slightly in that November supply and demand report. They did increase demand for feed use for corn 25 million bushels and soybean use for crush up 10 million bushels, but left the export categories alone. U.S. ag export sales were disappointing on the week. Export sales were down for corn, soybeans, and wheat. They were up week over week for grain sorghum. Corn, once again, this marketing year continues to disappoint and fell below all pre-report expectations. Open interest futures and options positions for Chicago wheat and Chicago corn were marginally up this week, while soybeans were up 5% in those open interest categories. And then money managers sold out of the feed grains while buying some soybean net long positions. Weekly USDA export inspections saw a reversal of roles as corn had a much improved week, while soybeans and wheat were significantly down from their recent volumes. Both soybeans and wheat fell below all pre-report expectations. And then 96% of the U.S. wheat crop has been planted to this point. Although the condition is historically low, we have seen some improvements over the last couple weeks with some of the recent rains.
So definitely things to watch there, especially watching the wheat, condition. As you said, it's been very dry for this time of year. Watching especially the river transit that's been struggling to go through. But looking internationally, obviously the markets are going to continue to watch the Black Sea region. They're kind of anxious to see what forms there within continued possible extensions of trade discussions. But I want to talk more broadly today about trade. And how it relates to some of the climate goals that are being set by countries around the world. Going on right now, we have COP27. And so within that, for those of you who don't know, that's the Conference of Parties of the UNFCCC, which that's the United Nations Climate Change Conference. So that's a mouthful. It's a lot going on there. But one of the initiatives that's been talked about at this conference last week, and it'll continue to be going on the rest of this week, is the willingness to open up free trade among nations to try and reach climate goals. Now, long term, what does that mean for agriculture? So, Ben, what does that possibly mean for U.S. farmers whenever we're looking, several years into the future?
Great question. Very different than what we normally talk about, but good question. I'll start with the free trade one. I think that was your first question there. Trade by nature allows people that produce something well and potentially produce it at its lowest cost value to basically produce that for the world while allowing somebody else the opportunity, if they don't have to dedicate resources and time to producing that object, that they can produce whatever is their biggest ticket item. Okay. And so just by the nature of that definition we call it our comparative advantage. What do we have as a comparative advantage over somebody else? By allowing every country to produce to its comparative advantage, you would expect that people would use less resources, use fewer amount of time, and produce it at its cheapest product, right? Like that's the nature of kind of that definition. And so I do think that, I'm not surprised to hear people talk about, hey, we can reduce, climate emissions globally by increasing trade, because that's the definition of it. In a lot of ways, is allowing people to produce it as best as they can. Here in the United States, though, in countries around the globe, we produce a lot of products for a range of different things. That might be national security, that might be controlling the supply chain. We do things and compete in different realms for a variety of reasons, and all those play out in the public market, if you will. Specifically related to agriculture, this probably continues to allow us to look at things like soybean oil over palm oil, for instance, and products where we have products that we can produce cheaper and cleaner and lead to less global emissions just as a result of the relative terms of the products.
Well, and it's interesting looking at how the U.S. might be positioned long term for international trade. Whenever we talk about the technologies within agriculture, it always seems like, the U.S. is on the forefront on a lot of these areas. But obviously, whenever you're trying to set projections for future trade, you can think things will be fairly similar tomorrow as they are today, and then the next day. But whenever you start getting, 5+ years down the road, things get very unstable. So how can you even start to form, I guess, expectations for trade whenever looking into the future several years in advance?
There's some things you can't, right? So like this whole notion of climate friendly trade, that's hard. That's difficult. You don't know what type of domestic policies people are going to have. They're going to continue to drive this, and the will of the people can change, and so making plans something for 10 years down the road is kind of a risky business because it might never come to fruition or whatever. I will say though that we just hosted a Cochrane group, which is these are USDA programs that allow people from other countries, businesses that are interested in buying U.S. ag products, to come here to the United States to do education tours and stuff like that. We had a Cochrane group that we hosted here at the University of Missouri from the country of Colombia that was interested in learning more about how we produce corn and how we produce ethanol, because they're looking at ways of increasing biofuels within their fuel use, but they want to make sure that what we're doing here in the United States doesn't counteract their goals within the country of Colombia. So, those are opportunities. Colombia does buy ethanol and corn from the United States. Can we say 5 years down the road that they're going to drastically increase their consumption of those products? I think a lot of people in the corn industry would say, yes, we certainly hope so. If you're a livestock producer, you're saying, no, we don't want more competition for our feed. We want that to remain here. And so people look at this differently, but certainly, it comes back to a country's comparative advantage to produce a product as quickly and as cheaply and as efficiently as possible.
Well, and one of the things that's really interesting to me is the discussion that's been going on throughout the country the last 2 years. Whenever we're looking at carbon markets, carbon programs, how will scoring work on these? How will those programs pay out? So, how do those programs? And this is more of maybe a rhetorical question, because I don't know that there really is a clear answer. But how do you start to really decide what products are creating green practices that are, maybe premium products on the market whenever you're looking at trying to, a country buy green products? Just trying to set a scale to really measure one against the other, it seems like a very daunting task, especially when you're working, across different countries.
Yeah, so good question. I'll just simply answer this by saying that in some cases, certificates do actually generate a premium. You can think about different ways that we've classified and differentiated products here in the United States, whether that be organic, GMO-free, in some cases, all natural, right? Those are all brands. They have a certificate, they live up to standards in some cases to be able to get that certificate, and then that draws a premium within the market. The concern that people have, and it's a very valid concern, is how do you enforce that the certificate is actually doing what it says it is? How do you enforce it to make sure that people are actually, if they have a certificate that has their product, are they doing that? The second thing that I think really comes into play here is understanding, the difference in the market. Like, it's not good or bad, right? Like, if somebody's out there branding something as climate smart, let's just say it's climate smart's the new certificate that's going to come up, right? Well, that's targeting to a market that cares about climate smart and is willing to pay more for that certificate to the producers that's doing it, however they choose to do it, whatever that might be. Well, that's not to say that, like, not following that certificate is necessarily bad. It's still producing product for the global market, and that's where I think we get into these feuds is people, then all of a sudden prioritizing one product over another. And it's really just allowing producers to take advantage of higher prices through those certificate programs and generate premiums, if you will. So
it's really too one of these discussions where there's so much gray inside of it that it's hard to see what'll happen long term. But it kind of tends to be that the market works itself out and usually figures things out on its own, and kind of I don't know, reaches a point where there's room for a lot of producers within any type of market, obviously. But
this was Adam Smith's whole concept. So the father of economics, he believed in the invisible hand, that the market would push product in directions to match the consumer, and allow money to flow where it is. So that's the invisible hand concept that you just talked about.
Yeah. But and one of the interesting things is when you have different consumers in the market that have different regulations across countries. Obviously, the EU is a lot stricter on production practices, and getting products into the EU than we do in the United States, and so that creates a little bit of trade friction, or a disallowance of certain products moving. So do you foresee some of those regulations maybe shifting as we look at trade policies that could lead to a push toward net zero? It feels like a loaded question. So
yeah, I don't know. I don't even know how to answer that, to be honest with you, because I don't even know. Like, I don't even know if we know what practices would qualify or even be available. Yeah. So there's a push right here in the United States to increase double cropping or cover cropping during the winter months. We have crop insurance incentives that now abide by that. Cover crops are now considered good farming practices within the crop insurance guidelines. So we're seeing some movement on our domestic policy that, while might seem small in nature, these are things that allow proponents of cover cropping to say, hey, this is now part of our suite of tools, or it's a part of our product. To what extent those filter out into the global market, I have no idea. But those are examples here domestically.
Yeah. But I don't know, looking elsewhere, I don't know that there's too much else I want to address it in this, very loose. It feels like a very ambiguous discussion to be having, because I mean, looking at the discussions around COP27, a lot of it, the fears tend to be around, unintended consequences of a subsidy war, and just I guess governments financing certain practices over others, and then you have maybe green practices that are dependent on government support instead of actually being facilitated by the market.
Yeah, that is a concern.
So, all right. Well, looking forward to the rest of this week, Ben, what reports and things should farmers be watching?
Yeah, so on Tuesday of this week, which this will come out by the time that this recording comes out, but we do have the National Oilseed Processors Association October volumes coming out on Tuesday, November 15th. On Wednesday, we have the ethanol and energy sector reports in the morning. Thursday, export sales. And then Friday, Commodity Futures Trading Commission data and cattle on feed at 2:00 to kind of get an estimate of the amount of livestock feeding units out there eating corn and other types of products.
All right. So always some good insight and good thoughts from you, Ben. I appreciate your time this afternoon. Listeners, viewers, if you'd like to learn more, you can do so at brownfieldagnews.com. You can also check out our sister program, the weekly livestock market update, that is with Scott Brown from the University of Missouri and Brownfield's Megan Grevner. I'm Will Robinson. I appreciate you joining us today on Brownfield.